Morning, everyone. Thank you for joining us, as I'm sure you'll all be incredibly busy at the moment with the new term and preparing for external audits and things, so really appreciate you joining us. I'm Louise Bridget, partner here at Francis Clark and head of the not-for-profit and education department for the firm. So just a quick summary about what the aim of this morning is. So it's primarily to give you an overview of this year's changes to the Academies Accounts Direction and the 2025 Academy Trust Handbook. We also just wanted to give you this opportunity to give you a heads up about some of the accounting changes that are coming down the track, and Darren will cover some of those in his session shortly. Please use the chat function in the webinar if you've got any questions, and we'll either cover those at the end of all of the sessions or when we circulate the slides. Just a reminder, this session is being recorded so that colleagues who couldn't attend live are able to watch it at a later date, and we'll also provide the link to all of the people here and anyone who's registered. So if you feel that this would be useful for other colleagues who maybe didn't register or didn't think it would be applicable to them, please forward it on and circulate it. That's absolutely fine. So as a sector, we know that you're facing challenging times with higher costs and other pressures such as the increased SEN demands, and that's leading to a greater number of trusts in deficit. And we do consider all of those issues when we're in our audit planning and also throughout our audit. So if there's anything that you want to discuss with us at that point or at any point during the year, please feel free to do so. We know that it's challenging and it can be difficult, and there's lots of balls that you're trying to juggle and lots of things that are going on. As well as bringing our accounting and audit expertise, we're also here to help in lots of other ways. So whether you need support with cybersecurity, Cyber Essentials or Cyber Essentials Plus accreditation, for example, or whether you need VAT advice or any of the other things that we can offer as a firm, please just talk to your audit team, talk to myself or Darren or your engagement principals. We're always here to help. So you can see on the slides there your two presenters for today, so Darren Perry and myself. So I'm just going to hand over to Darren without further ado to start with our first session.
Okay, thank you, Louise, and good morning, everyone. For those of you that don't know me, I'm Darren Perry. I'm a director based in our Truro office, primarily looking after our charity and academy and not-for-profit clients. And so, as Louise mentioned, I'm going to start the webinar today with a review of the changes in the 2024 to 2025 Academies Accounts Direction, which is a guidance to assist Academy Trusts with the preparation of their accounts for the year ended 31st of August 2025. So in terms of the changes, well, I think the good news for this year's accounts is that they are very minimal this year. So just to cover off a few points, the Academy Accounts Direction has now included a reminder that under the Companies Act, academies with turnover over 500 million and over 500 employees are required to include non-financial and sustainability information in their strategic report. And secondly, the Academy Accounts Direction has been updated for disclosure guidance following the relaxation of the requirements which allow Academy Trust to take out certain finance leases. So just as a reminder on the finance lease point, from the 1st of September 2024, academies were given delegated authority to enter into finance leases on a specific DFE approved list, which, as you can see on the screen, that includes things like IT and telephone equipment, catering and cleaning equipment, gym equipment, groundskeeping equipment, minibuses and other vehicles used by the school, temporary classrooms, and also LED lighting systems, or to support renewable activity where that product has been sourced from Get Buying Help from Schools or from another recommended route on the DFE Finder Framework website. Now, given the changes, it's quite likely that most academies won't have had finance leases necessarily in the past, as you needed specific permission for them. So just as a reminder, if you do enter into a finance lease, those assets will effectively get recognised on your balance sheet at the fair value of the leased asset, and then there's also a corresponding creditor for the obligation going into the accounts. In terms of the other disclosures, there will then be an update to the notes and the accounting policies on areas of judgment. You will have a note under your fixed assets just setting out the net book value of assets held under finance leases. And then there will also be a finance lease obligations note that splits the future minimum payments of that lease between less than a year, 2 to 5 years, and over 5 years. So that's all that's actually really changed in the Academy accounts direction, but we obviously also have the model accounts, which they publish every year. And there are some narrative and disclosure points changes included in them. So first of all, if we take a look at a few updates to the wording in the statement of regularity, proprietary and compliance that is given by the accounting officer. They are relatively minor changes, but they've updated the references to refer to the Department of Education rather than the ESFA. And there is also now broader reference to the framework of authorities governing academies. And if you just look at the final point that the accounting officer has to state at the bottom, it just now refers to that they confirm that there's been no instances of non-compliance have been discovered, whereas in the past it was specifically no instances of funding non-compliance. So they've slightly broadened the wording that the accounting officer has to give in the accounts. Then the model accounts have also just put in a reminder that trusts that've got over £50 million income should be using an internal auditor or buying in an internal audit service. There are various narrative updates that have been made primarily to the audit report and the regularity report that we would give as auditors. And that's primarily now referencing the Secretary of State and the Department of Education rather than the ESFA following the changes, and to give specific reference to the framework and guide for reporting accountants that they publish. And then finally, in the Teachers Pension Scheme note, there is just an update explaining the implementation date of the latest TPS valuation and when the next one is due. That's just changed very slightly. So that is actually it for changes this year. So hopefully on the account side, it should all be relatively straightforward. However, I did think it would be useful just to highlight some more significant changes that might be coming down the line in the future. And the reason behind these is that the main accounting standard in the UK, which is FRS 102, that's been updated to reflect changes in international standards. And then as a result of that, the charities statement of recommended practice is being updated to tailor this guidance to charities. And an exposure draft of that updated document has been published and consulted on. Now, given Academy schools are charities, that means those changes are also going to flow through to academies in due course. Now, the main changes are around certain disclosure requirements, and then also specifically the approach that's made to recognising income and recognising leases in the accounts. Now, from your point of view as academies, these won't be immediate changes. The requirements come into effect for accounting periods beginning on or after the 1st of January 2026. So for a normal academy year end, you're looking at the year ended 31st of August 2027 being the first one that is sort of formally affected. Now, given that they published an exposure draft of the charity SORP, we've got a fairly good idea of what it will look like, but obviously we don't yet know how that will feed into the Academy accounts direction in due course. However, just to give you a brief sort of outline of some of the changes that are likely, well, the charity SORP has used a new tiered reporting requirement, affecting the level of disclosures required in the trustees report, depending on the income level of the charity. Now, Academy schools already have a very substantial level of disclosure in the Academy accounts direction, which goes above and beyond the charity SORP. So I'm not necessarily expecting many additional changes to come in there. However, the SORP does have in it a new sustainability section, which is encouraged for smaller charities and required of larger charities to explain how they manage environmental, governance and social matters. So I think that's something that is quite likely to feed in due course. And the new proposed SORP has put in a cash flow statement exemption for the largest charities, for charities with incomes of less than 15 million. But again, I think it's quite likely that the Academy accounts direction may well still require a cash flow to be included for academies. But in terms of the other main changes, income recognition is an area where the general approach has been changed. So the charity SORP guidance has now been split into two types of income transaction, what are called exchange transactions and non-exchange transactions. And specifically, the way that you approach income recognition, there's a specific 5-step process for exchange transactions. So that is where you're effectively supplying a good or service under contract in exchange for consideration. For non-exchange transactions, which is things like general grant funding where the funder doesn't get a specific service in return, there are relatively minimum changes. However, I've just got up on the slide there the 5 steps that you will need to follow when these changes come in that determine how and when income is recognised. So the first step is to identify a contract, which is something that creates enforceable rights and obligations between the two parties. You then have a look at what those obligations are. So, for example, is there a distinct good or service being delivered separately? Is there a series of services being delivered, or a single obligation that you've got to complete under that contract? Once you've identified the individual obligations, you have to look at the contract to see what is the transaction price, and that may be very straightforward, or it's always possible that it's variable due to things like discounts, rebates, and so on. And then you then take that amount of income and allocate it to each individual performance obligation. And then when that obligation is met and that good or service is provided to the third party, you then recognise that chunk of income in the accounts. So you may be in a situation where that recognition is over a period of time. So if you're offering a series of sessions or training courses over a period of time, it might be that you recognise part of the income after each individual one is completed, or potentially just at a single point in time when the individual good or service has been properly supplied. Now, in terms of that more general guidance on academies specifically, I'm not necessarily anticipating that the change to the approach to income recognition is going to make a significant change for the majority of academy schools. I think if you think about your typical income streams, well, for example, you've got your main GAG funding. Well, that is clearly provided for each academic year and is a grant. So I think it's very likely that's still going to be recognised in full for each academic year as we do now. If you think about things like school trips, well, I think in those circumstances, you would consider that the obligation is satisfied when the trip takes place. But again, they're very likely to be tied to individual academic years as they are now. So I'm not anticipating particularly any changes there. If you're charging fees or other charges to parents, they may well be something where the income is recognised over time as the service is provided. But again, given the nature of academies and the very clear academic year, I think probably a lot of those services are also matched to each academic year. So again, I wouldn't necessarily see any changes there. And so really, I think it's going to be probably the larger multi-academy trusts that perhaps have some more unusual or more commercial services being offered that could be affected by the change in these income conditions. And equally, as this is coming from FRS 102 and the underlying accounting standards, it does mean that if your multi-academy trust has a subsidiary company, for example, that does more commercial activities, the changes could equally apply to them. But I think probably in the majority of cases, that isn't going to have a huge impact on our academy clients. Now, the other fairly big change in the requirements going forward are in respect of the recognition of leases. Now, I briefly touched on what you do with finance leases earlier, but previously and currently we've got the situation where operating leases and finance leases are treated differently in your accounts. So as I mentioned earlier, finance leases go on the balance sheet, But operating leases are effectively just recognised as an expense going through your statement of financial activities. When these changes come in, that distinction will no longer exist. And that means that in general, operating leases will have to be brought onto your balance sheet. So that basically means recognising a right of use asset when you take out the operating lease and a corresponding liability. Now, the good news is that there is an exemption for short-term leases, so ones that are below 12 months long with no purchase option. And then there is also an exemption for what are called low-value assets. Now, low-value assets haven't been strictly defined, but they do tell you some things that they're not. So it won't be things like cars, vans, and land and buildings. Therefore, practically, the exemption is going to be given to things like the photocopier, operating lease, franking machine, laptops, water cooler, that sort of thing. And under the exemption, those can still be recognised purely as an expense on a straight line basis, as you do now. The interesting point on that is that you do need to consider the nature of the asset, not specifically its outright value. So as an example, if your academy school has got an operating lease for a minibus, that is going to need to go on the balance sheet because that is not treated as a low value asset. However, if you've got an operating lease for perhaps 50 laptops, by their nature, they may be considered low value assets. And so even though the total value may be higher, they will be exempt and still go through as an expense. Now, there is a lot of very detailed technical guidance on this about how you recognise leases, how you deal with lease incentives, modifications, and so on. And that could be a seminar in its own right, and it is something that we can give you more guidance on in due course. But for the purposes of this session, I just wanted to give you a really basic example of what the calculation might look like, so you can start to see the impact that it could have on your accounts. So let's just take a very simplistic example and say that the Academy has got a 5-year property lease on a building at £10,000 a month, running from the 1st of January 2025. And for the purposes of this example, we're going to say that the Academy could obtain finance for 6% at 6% interest per annum and has got the normal 31st of August year end. So for the year ended 31st of August 2025, it's going to have made 8 payments of £10,000 a month and have an operating lease expense or a rental expense of £80,000. Next year, in the year ended August 2026, is going to have 12 payments of £10,000 going through, which is an operating lease expense of £120,000. And so on the 31st of August 26, under that lease, there's still another £400,000 of outstanding rental commitment. So that's where we are now. So as I mentioned earlier, for most academies, the new SORP applies for the year ended 31st of August 2027. But that means on the first day of that accounting period, you need to bring in the present value of the lease commitment. So that means effectively working it out as at the 1st of September 2026. Now, under these requirements, you won't need to restate any comparative year figures, but you do need to work out the present value of your committed lease payments at that point in time. And to do that, you need to decide on a discount rate to use to discount those future rates back. Now, the charity and accounting guidance says that you might use the interest rate implicit in the lease for that. If not, it says you might want to look at the borrowing rate that the charity could obtain from a high street bank for a loan of a similar value and similar term. However, obviously, because most academies aren't allowed to borrow, it's very unlikely that you will have any sort of history of borrowing with your bank providers. And therefore, it may be the case that you simply need to use the rate of interest that you can obtain on term deposits to work this out. But if you work through the calculations there on the screen and you work out the present value of those future lease commitments, in this example, we end up with a right of use asset of £352,000 and a corresponding lease liability. And they're going to then go into your accounts and on your balance sheet. So if we just take a look then, what happens and what it looks like during the year to the 31st of August 2027, well, that right of use asset, you will depreciate that over the remaining lease term and charge depreciation on it like you would any other asset. So in this example, you get a depreciation charge of 105,000, and on the balance sheet at the end of the year, you'll have an asset remaining with a value of 246,000. And in terms of the lease liability, well, you've continued making your £10,000 monthly payments over the course of the year, so that's knocked 120,000 off your liability. But there is an interest charge as you unwind the discount. And so in this example, whereas under the current rules and the old rules, you would have simply had a rental expense of £120,000 going through. Instead of that, when the changes come in, your accounts will show a depreciation charge, in this case of 105,000, and an interest charge of 21,000. And very generally, that means you're probably going to end up with a higher expense going through your accounts in the early years due to the interest, but that then becomes a lower expense in later years, and it will ultimately all balance out. So moving on then to the next slide. The question is, does this all matter? Well, for Academies, I think this is primarily a mathematical and accounting matter for your finance team. And it may be the case that you need to explain the balance sheet changes to your trustees and the users of the accounts. More widely, these changes do affect gross assets. So in the wider charity sector, that could impact things like audit thresholds. But as an academy, you already have to have an audit. So that's not going to make a difference. Likewise, in the more commercial sector, the changes could affect compliance with things like bank covenants, calculations of bonus arrangements, and so on. But again, I don't really see those things as affecting academy schools very likely. But one area where it might be, you might need to have a look at is where academies have got lease arrangements at below market value, or equally where they've got a lease at a peppercorn rent. Now, it may be the case that some of those peppercorn leases don't meet the definition of a lease and therefore can still be treated in the same way. But like we do now on, for example, diocese schools, in those circumstances, you may still need to consider recognising a notional donation and notional expense in your accounts to reflect the value of the asset that you're being given at a peppercorn lease. So just something that's really worth starting to giving some thought to. So do just have a think about, you know, what leases you've got, summarise the terms, and start having a look at the calculations so you can get an idea of the likely impact. And in due course, we can provide you with an Excel working schedule that you can use to work out the calculations. Okay, moving on then. And really just a few very quick reminders at the end now. So the guidance that is out there, I've put the web link to the government.uk website on the screen there, but you've got the main academy accounts direction and the model accounts. And then also there is a framework and guide for external auditors and reporting accountants. That is obviously aimed at us as auditors and accountants, but if you are specifically interested or want to look up any particular requirements that it puts on us to ask you about, that's available. And whilst it hasn't been published yet, we are expecting the usual update giving submission instructions for your 2024 to 2025 financial statements in due course. And then finally, just with dates, the submission deadline for your year-end accounts will remain the same at the 31st of December 2025. So that's going to be for your accounts, your audit findings report, and then there'll be the same again as last year, that we're expecting a account submission cover sheet, and you're going to need to include a summary internal scrutiny report from your provider. In terms of the annual accounts return, the submission date hasn't been published yet, but is expected to be late January 2026. For context, it was the 28th of January at the beginning of this year, so we're expecting very similar. And then just a couple of other reminders. You are required to publish your full statutory accounts on the Academy's website by the 31st of January 2026. And you do need to retain at least 2 years online. And then finally, your accounts will then need to be submitted to Companies House by the 31st of May 2026. So that's just a quick summary of the deadlines and what's changed on the actual accounts front. And that concludes my part of the webinar. So I'll pass you back over to Louise.
Thank you, Darren. That was really useful. And I think just a couple of things I wanted to add to that. So in conversations that I've been having in the sector, so whether it's the Academy Auditor Forum or other conversations we have, there is definitely some appetite for, particularly with the new changes coming through with FRS 102, for there to be some guidance from the centre on some of the very common income streams, because there is so much standardisation across the sector. So, for example, GAG and lots of the other grant income streams that you receive, it seems sensible that there is some standardisation and some guidance that comes through. So we're hoping to see that. And the other thing I just wanted to pick up was, obviously it's a lot to think about there, and I really appreciate that heads up that Darren's given you. And I think prior planning is definitely going to be the key to this, but we will help you with that. So as soon as the guidance is firmed up and more definite information comes through, the charity SORP is finalised, etc., please watch this space. We will have blogs on our website, and we may do a separate webinar just to cover what those specifics look like, but also please talk to your teams about it. So obviously at the moment things are still a little bit up in the air. We think we know roughly what's coming, but in order to be prepared, I think just encourage you to talk to your teams as much as possible, and also let us help you. So coming on to the Academy Trust Handbook. So I thought it would be useful just to have a quick recap on the purpose of the handbook and to think about how it's evolved from its early days, particularly over the last couple of years. And so through the handbook, the DFE provides an overarching framework for financial governance, management, and other controls for the sector. And it is a condition of the funding agreement between each trust and the Secretary of State for Education that trusts comply with the requirements. So it is one of those real cornerstone documents, as I'm sure you're all familiar with. So anyone involved in leading, governing, managing, or auditing a trust needs to have read and understood the handbook. So it's really important, I'm sure I say this every year, but I'll not apologise for saying it again, that the new version needs to be circulated in your trusts, and a real emphasis placed on it that people do need to read and understand what's in there and what the requirements are. The DFE is very keen to encourage trusts to use the handbook as a tool for continuous improvement, rather than it simply being a checklist or something you refer to when things have potentially gone wrong or look like they might be going wrong. And I think that's why over recent years there's been a real drive to signpost other guidance and best practice within the handbook, just to help that best practice and for you to learn from other trusts and what's going on. And the handbook should also be used as a support tool, so to help you make well-founded decisions and to strengthen and improve your internal controls, and to really develop a robust and effective governance arrangement. So that's just a bit of a refresher about what it's there for. It's been around for a long time, but I think sometimes it's good to sort of go back to first principles and think about why it's there in the first place. So these are some of the things that it covers. Most of these you'll be familiar with. So the trust's financial responsibilities, as you would expect, and reflecting the principles in the Treasury's managing public money. And that's a theme that you'll see coming through quite strongly all the way through. I've already mentioned the signposting for other responsibilities. So on the slide there, just mentioning safeguarding and estates, but there's others throughout. It also is very prescriptive where trusts must get DFE approval, and that's why it's really important that people in your trust have a working knowledge of the handbook and have really understood where those requirements sit. External auditors in the sector, so I've already sort of alluded to some of those conversations that go on amongst us as an audit sector. We've been identifying an increasing number of instances where there have been non-compliance with the handbook, particularly in the areas of related party transactions, severance pay, all of those knotty issues that we all like to grapple with. And very frequently, those are to do with not obtaining prior approval or potentially not notifying DFE in advance of a transaction. So there's been an increase in modified regularity reports as a result. So if you've got a really good working knowledge of the handbook, you can hopefully be flagging those things and being aware of where potential issues could arise before you get to that point and before we pick them up as auditors. Just a reminder there that the edition we're talking about today is effective from the 1st of September 2025, but as an audit team, we will be looking back at last year's edition and checking compliance with that. So we always have this strange situation going on where you're working with the new handbook, but we're still looking back at the old one and just getting to grips with what's been done through last year. Part of the signposting role, as I've already alluded to, other reading material that's listed in the Academy Trust Handbook, Good Practice Guides, Charity Commission Guidance. There's links there on the slide to all of those things. So I think it's a really good one-stop shop, particularly for things like the Power Hour video. Some of you may be familiar with those. They've done some really good ones on related party transactions, for example. So just keep an eye out for those when they come through on the weekly bulletins, but also there's some really good links in the handbook there to help you. So what's new? So similar to Darren's session, really, there's nothing particularly earth-shattering. I think, although earth-shattering pun there with the world being held, that wasn't deliberate. I think the days have gone where we used to do these refreshers and every year there would be a huge raft of changes. I think the handbook has reached a real maturity now, and it tends to be just tweaking or where things are being seen in the sector. We're trying to help and give more guidance on that. But one of the things that is new this year is that increased sustainability focus. And Darren mentioned in his session about the focus on sustainability coming through in the accounting, and it is very much the same with the handbook. So you'll probably be aware of the need of all settings, including Academy Trust, to have a sustainability lead and a climate action plan by 2025. And the new handbook provides some helpful links to the documentation, which will hopefully support that process. So it's a good place to start looking if that's something that your trusts are currently working on. Roles and responsibilities. So this has always been a really strong part of the handbook and one of its key areas that it's focused on. So the handbook confirms that trusts need to have a really good understanding of and be working towards the 6 core digital and technology standards by 2030. And as you'll be aware, cyber incidents and attacks are having a significant impact on schools and colleges, and those impacts can be felt either financially, operationally, and reputationally. So it's something that organisations, whether it's in the academy sector or beyond, are all struggling with. You'll all be familiar with Marks and Spencer's, for example, and what happened this year, and they're still not back up and running, despite that, not fully back up and running anyway, despite that attack having happened months and months ago now. So it's definitely something that everyone is focusing on. So the digital and technology standards are designed to make sure that schools and colleges build their cyber resilience, and that the coverage is in the areas that are outlined on the slide there. So broadband, cybersecurity, digital leadership, and governance, for example. And as I mentioned in my introduction, please remember that we can help. So if you have any questions around cyber or would like to know what support we can offer, please just let us know. Some of you may remember Phil Osgathorpe. So he's one of our directors and he heads up our IT assurance and cybersecurity services team, and he presented at previous webinars. I think he did a session last year, and he's always very happy to have an initial free conversation with you about how we can help, whether that's accreditation, cyber essentials, or whether it's something more bespoke. So please don't forget that that service is there. Again, on the roles and responsibilities, so estates have become increasingly topical for trusts, and the handbook makes the point that a trust's estate is both an asset but also a mechanism for delivering outcomes for students, and therefore it needs to be managed accordingly. So the DfE expects you to manage the estate strategically, effectively and safely, and this obviously includes a requirement to comply with health and safety legislation, etc. There are some helpful links in the handbook to other key sources of estates information. Again, that signposting role. So another change is an update to the accounting officer duties and a reminder that this office has specific duties in relation to financial matters. So the accounting officer has a personal responsibility to Parliament and to the DfE's accounting officer for the trust's financial resources. This also extends to the accounting officer having a personal duty to raise any concerns if they feel that the trust is not complying with the funding agreement or the handbook. So again, if people in your trust are reading the document, I think that really comes to the fore in this new edition. In this edition of the handbook, the definitions of regularity, propriety and value for money, as well as feasibility, have been updated and clarified so that they better reflect the requirements of managing public money. So again, just trying to bring everything into alignment and make sure that everyone's singing from the same hymn sheet. Just on financial requirements, so there's some more guidance and support there in relation to procurement, so the new Procurement Act 2023, and also some links to the Find a Tender service, which you might find useful. Darren, in his session, mentioned the £50 million income threshold for internal scrutiny provision. That has now been clarified that that 50 million figure is from your last set of audited accounts. So there was some confusion in the past about when that 50 million kicked in. It's now been clarified that that's the number that you take. And then also just noting that where you have novel, contentious or repercussive transactions, that repercussive transactions could be those where it could actually lead to additional costs for other parts of government. So if it's something that filters through and becomes something significant for the sector as a whole, that could be deemed to be a repercussive transaction. So just something to think about there if you're coming across any of those in your trusts. Financial requirements again, so executive pay has been a tricky issue in the past and continues to be something that people struggle and grapple with. So the handbook this time takes the opportunity to clarify the role of the board in setting executive pay. So you can see there some of the things that they require. There must be a documented agreed pay policy, which includes the role of the board, what level of scrutiny there will be given, how you deal with proportionality, value for money, etc. And there needs to be documented decision making around the rationale for setting executive pay. You can see the responsibilities here on the slide, but section 2.27 onwards in the new handbook has the full guidance. And there's also a section specifically at 2.30 setting out that the trust is actually responsible for ensuring that all senior payroll arrangements fully meet tax requirements. So again, that's something new and just something to focus on. So as well as the main changes that I've highlighted or updates that I've highlighted so far, there's just some other areas that the DfE wish to highlight in relation to their role as regulator, and you can see these here. So with regards to cybercrime, the handbook states that the DfE supports the National Crime Agency's recommendation not to encourage, endorse or condone the payment of any ransom demands. Fairly obvious, you would have thought, but payments of ransom has no guarantee of restoring access to services and actually is likely to result in repeat incidents. So just something specific there to point that out, but I'm sure those are all things that you would have considered anyway. And then just around the notices to improve. So the list in the handbook of when one of these might be issued has just been amended to say that educational performance has now come off that list. So that's now been removed. But other areas where one could still be issued is around things like poor internal scrutiny or an actual or projected deficit. And then just a note there to say that DfE may recover funds where there is evidence of irregularity or fraud. Again, probably not that unexpected. So really, in summary, as you can see, not a huge amount to note, but I think the things that we've focused on here are useful to know. Some useful clarifications and more signposting, and I definitely see that being what will happen in future, that will just get more and more significant. As I've already said, please make sure that the relevant people know where to find the handbook. So if you need to, perhaps send them another link to where you can find it online, and that they understand why it's so important that they do read it and understand it. Obviously, we're not expecting somebody to be able to repeat the handbook verbatim. Darren and I don't want to be able to do that either, but just at least to know where to look and the sorts of things that it covers, and to be able to flag when there might be an issue. And I also think that with each issue of the handbook, it's a really good time to review your policies and processes and procedures, think about whether they may need to be updated. So for example, the pay policy that I talked about earlier, and it's just good to have a refresh and think about what the new handbook might impact in terms of your rules within your trusts. As always, please talk to your audit teams, let us help. We're dealing with the handbook and the requirements in lots of different trusts, so where there are areas of judgment, etc., we can be quite a good resource in terms of just having those initial conversations, and we'd always rather have those conversations early if you're struggling with something and we can come to some sort of consensus. So quite a quick session today. I'm sure you won't mind getting some time back in your diaries. We know what it's like, particularly at the beginning of term. I haven't seen any questions coming through in the Q&A, but I will just check. No, nothing there. If you do have anything you'd rather just drop us an email, our email addresses are on the slide, so please do that, or please just talk to your audit teams. But otherwise, just to say thank you once again, please circulate the session as you see fit, and we will be in touch shortly with more guidance as it comes through. Thank you very much.